Hello everyone, welcome to another Quant webinar. This is your host Satish Maurya. Thank you for joining in today. For those of you who are joining for the first time, a quick introduction to Quant is a leading algorithmic and quantitative training and research institute that offers one of the world's most comprehensive ecosystems around quant and algo trading. Since 2010, we have helped millions of people in over 190 countries with our educational initiatives. We help people build expertise in this rapidly growing domain. We also enable institutions to offer algo trading tools to their millions of users by leveraging Quantinsky's institutional grade technology and trading platform. For today's webinar, we have a topic that is on common errors by algo traders and how to avoid them. For today's webinar, we will be joined by Jay Parmar. Hi Jay, thank you for joining us today here.
Hey Satish.
Great. So Jay is here. Quick introduction to our speaker. Jay is a quant researcher at iRage, a leading high-frequency trading firm in South and Southeast Asia. With a decade of experience in the field, he is a seasoned professional in quantitative research and also a co-author of a well-regarded book called Python Basics with illustrations from the financial markets. Jay excels in applying machine learning techniques and quantitative strategies across various trading verticals, leveraging his Python expertise to develop robust and data-driven solutions. Now, before we start today's session, please keep in mind that we will be addressing all your questions at the end of the presentation. So don't hesitate to share your doubts in the questions panel. Also remember that this session will be recorded and made available on Quantinsky's YouTube channel. So do make sure that you follow our YouTube channel for many other webinar recording in the future, as well as if you want to refer to some of our past webinars. Now let's jump into today's knowledge pack session on uh, mistakes made by algo traders. So Jay, the stage is yours.
Thank you so very much, Satish, for the introduction. Hello everyone. I believe you guys can hear me loud and clear. This is your host and presenter Jay here. Today we are going to spend the next chunk of like 40 to 45 minutes on discussing the common errors made by algo traders. And as you guys can see on my screen, which is like I would say the title of those today's webinar. So, before we begin, here's a mandatory disclaimer. So, whatever information that we discuss today should be and taken solely for educational purpose and not financial advice. Please use your intelligence wisely. Anything that happens or comes as an outcome of these webinar should not be like forwarded to the host or the organizers, right? All right, on to the topic. So we are going to discuss who algo traders are and what different kinds of errors they usually make in their different stages of algo trading, right? So who are algo traders? Algo traders are basically a class of traders who use technology to enhance their trading operations and smoothen them. Okay, and what do? They trade in a systematic fashion. They use systematic trading strategies which can trade on its own. They use computers to place orders, to modify them, to cancel them, and to basically make revenue out of them. Okay, so they often trade rule based strategies wherein they can use programming language, hardware, and the use of technology to place orders to trade on various exchanges at the same time using multiple portfolios, using different set of tools that are available with them. When they don't trade, they often spend good amount of time developing trading strategies, right? They essentially analyze market data try to quantify them and generate insights from those quantified data. Using the insights that they generate from quantifying that data, they try to build trading ideas and backtest them using the programming language or any other tool that are at the disposal of at them, right? So using the taking market data, quantifying them, analyzing them, coming up with the trading idea and backtesting them. These are the different stages of developing trading systems, which these algo traders often do in their time when they don't trade, right? And once they are happy with whatever simulations that they are performing, whatever kind of trading hypothesis that they are validating, they often go and deploy them. Now, depending on what kind of algo trader he or she is, some of them perform all these tasks on their own. In certain scenarios, in certain organizations, there are dedicated teams to who segregates all of these tasks, right? But more or less, these are some of the tasks that algo traders do, right? Mainly when it comes to retail traders, they tend to perform all these kind of tasks on their own. In a like well established firm, there are dedicated teams who basically are in charge of analyzing data, backtesting ideas, deploying them, and trading. Okay. So today, what we are going to do is like we are going to discuss some of the very common errors that can occur at any stages at any stages of the right from the analyzing data to the execution part. Okay, so the very first error which usually is seen among the retail traders and the traders of mid-size and the large size organization is not knowing the exact strategy. This error is as real as it sounds bizarre. It is often assumed that all traders know the strategy that they trade. Oftentimes, it is not the case. The reason being is like in a well-established firms, the traders are the ones who only trade strategies. There is other team of like researchers and analysts who develop the strategy. Okay, and it also goes equivalently well among the retail traders as well. The retail traders who tend to buy ready-to-use bots or ready-to-use algorithms from the market, and they just like run those strategy on their own. Now, this is a classical error that trader often makes because they really don't know what their system is doing, right? They are often involved in the task like I would say loading the portfolios which will be traded, the parameters that the strategy uses, but uh, they often don't have the whole understanding of how the strategy works, right? Uh, to become a better trader, it is always advisable to know how a strategy works, why it works, and whenever it takes trades, why those trades are being taken. Okay, uh, if the trader does not know the actual understanding, if the trader does not know why the trades are being taken, it is highly likely that the traders and the strategy will have contrary contrary views about the market. Okay, as we discussed, it is seen across retail traders and traders in the mid-size and the large size firms. Now, what can be an example? So example is like a trader trading, let's say, put call parity imbalance, which takes trades during the high volatility period, when the put call parity violates, and the trader only knows like how the strategy work, but it does like they don't know the actual mathematics behind the like put call parity, right? So these usually creates a contrary view about the market, and as a result, they tend to make another error, which is they interfere in a systematic strategy. Okay, so the strategy might have taken some positions, but the trader believes that they have more information about the market than the strategy. And under such scenarios, they might try to say offset their positions that the strategy would have taken, or they might take some contrary positions, right? Only to realize that over long term the strategy was correct, and the decisions taken by those traders uh, during those volatile periods, or I would say during when they believe that they are having like superior knowledge compared to the strategy, right? Was only a temporary phenomenon, but over the long run, the strategy was knowing exactly what it was doing, because strategy was well back tested, uh, un- or I would say the strategy was rigorously backtested under different market scenarios, and strategy had like all the components necessary to trade in the market. Right now, this particular error is very prone to be seen in the retail traders, because retail traders often gets swayed away by the market sentiments during market hours, and retail traders usually have all the control with themselves, right? So they are the one who will deploy their own money, they are the one who will deploy the strategy, and they are the one who can manage literally everything, right? So if a system has taken some kind of trades, and the market moves in the unanticipated direction, they believe that okay, the market is not going to work, or the positions that they are having would basically end up in losses, and they might interfere in the strategy within the industry setting, or I would say within the organizations. These things are very less likely to happen because of the controls, or the like I would say dedicated risk department that are set up, and they know exactly how things are working, right? So this is one of those things that should be avoided uh, in almost all scenarios, right? That you should not interfere with your systematic strategy. Instead, you guys should build a strategy with stringent risk with a stringent risk management system. Okay, your system itself should have uh, risk parameters in place that I would say uh, adds to your positions or decreases your position with respect to the market movements, rather than the trader trading themselves in addition to the system being traded. Okay, so I would say if you guys are trading a systematic strategy using any kind of algorithms, ensure that you have those stringent risk checks in your strategy, rather than interfering in the systematic strategy. So these two uh, these two errors that we just saw are the result of, I'd say, more of like sentiment, uh, or I'd say the curiosity to trade in the market. Okay, the next error that we are going to discuss is uh, relates to the stage where algo traders spend their time to develop trading ideas. Okay, so there can be scenarios where algo traders have identified some patterns, okay, when they are trading, and now they want to backtest those patterns. So say for example, I am trading and I basically observed some phenomenon in the market, okay, and that phenomenon picked my interest. So I want to now validate that idea and say that okay, whether I can capitalize it on or not, right? So my what I would do is like I would go to my resources, I would fetch the data, and I would try to validate that hypothesis. Okay, now whenever we will try to validate hypothesis, we need to ensure that we are following the correct process. Okay, oftentimes it happens that the backtesting or the simulations that are being done is often inadequate in nature. Okay, what do I mean by it is like I don't have necessary data to validate my trading idea, or I don't have right tools, right, that allows me to simulate data. Okay, so if I might be backtesting on say Excel instead of well-known programming languages that are hindering my idea. Okay, or that is hindering my process, or my process might not be that efficient, which allows me getting the realistic idea about trading. Okay, or I might not be having good quality data. If I have, I would be having only data for the brief period, right? So validating your ideas on a say let's say 1 month or 2 months of data usually do not convey realistic results, or I might not be knowing how to backtest in a correct way. So, for example, say I am trying to backtest ES futures, ES mini futures for the say 2 years, right? And I am using the near month future contracts for ES mini over past 2 years, right? Now, my strategy backtest ideas say on a daily basis, okay, and I intend to carry forward my trades over multiple days. Now in such a scenario, I get data say from some data vendor, and I can download for those individual expiries, and I try to use that data. Now to me everything looks okay, that okay, I got those near month futures data for ES mini for all the expiries that I intend to backtest, and I started simulating my trades. Okay, but one thing that I might be lacking, or I might be missing, is that before I can use that data, I need to adjust that data to create a continuous contract, uh, continuous futures contract before I can even start simulating trades. Now, if I had not known this step, even though everything goes well, uh, I would not be getting the realistic results, right? Because the data itself that I am using, or the process that I am following, is not correct. I do not have the real idea about how backtesting should be performed, right? So when we say inadequate backtesting or limited backtesting, uh, it pertains to the error that can creep in at any stage of your uh, data collection stage, analyzing stage, or quantifying them, or even validating or backtesting your ideas. Okay, so one of the examples would be say I simulate my trades from say for good 3 years, like January 2021 to December 2023, and it shows like decent CAGR with acceptable drawdown values. I am quite happy, and I say that okay, let me go ahead and let me try to implement, right. But my colleague says me that okay, Jay, before you go ahead, like have you tried it over like long term? I would say no. When I do that, when I try to expand my uh, backtesting data, I see that the CAGR drops down significantly with not so comfortable drawdown values. Okay, now why it might be the case? Two reasons. First, January 2021 to December 2023 is the period of bullishness across the globe, right? So it is highly likely that if I'm backtesting trend following strategy, I'm going to get good results, right? But the moment I include additional historical data, where markets were in a very choppy region across the globe, the stocks were not moving. Okay, it is highly likely the numbers would fall. Okay, and it shows the true nature of the strategy, that my strategy only works in a specified period. Now I should be very cautious in deploying such strategies. Now, if instead my strategy would have worked in that period as well, which is like January 2018 to December 2023, I would be pretty much okay to take the strategy to the next phase. Okay, so this is one of the examples. What can be another example? Another example is again, say I backtest my strategy on a brief historical data. So this is actually the performance results of the actual simulations, right? So over here I simulate my strategy over 8 months, right? And I see that okay, the sharp edge that has been generated is well above one with very minimal drawdown values, right? However, when I go ahead and when I expand my historical data on the same strategy, okay, on the same strategy, I see that though my strategy generates returns, okay, the Sharpe falls significantly, right? And the drawdown value increases from like somewhere around like negative 5.5 to almost 17%. Now, if I had went ahead with only these particular states, right, it is highly likely that I would have not been able to replicate the same numbers during the live market. Okay, but if I had the overall idea about how the strategy does, like under various market scenarios, I would be having realistic expectations out of my trading system. And when we say the limited backtesting or inadequate backtesting, it does not only uh, it does not only belong to or stops at the historical data, right? Let's say here I have another strategy which I have backtested on a static basket. So, for example, say I have backtested this strategy only on banking stocks, right? For the good 3 years of data, good 3 years of historical data, and I see that okay, it is generating like again really good numbers, returns sharp, and it even has like some alpha in it. Okay, but when I try to see the validness of this strategy and I try to increase I change from static basket to say dynamic basket, and I try to say that okay, whether the strategy really works or in the market or not, then I see that the returns drops drastically. Okay, my Sharpe ratio literally goes below zero point 0.5, right? And it has no alpha in it. What do I mean by dynamic basket? So I say that I change my portfolio, I change the constituents of my portfolio uh, depending on what assets are available to trade in the market. If it is a futures portfolio, I often work with different future contracts. If it is, say, if my basket follows some index, right? My constituents changes based on the index constituents. So dynamic basket simply means that I try to use whatever stocks that are available, or whatever contracts or instruments that are available to trade on that particular date, rather than trading the same instruments all the time, right? Now, why should we go for a dynamic basket? Because dynamic basket provides diversification. It basically allows your trading strategy to generalize well. Okay, so oftentimes algo traders who are new to backtesting, who are new to quantitative finance, right? They often, I would say, overlook these very small but important details. Okay, so and this is quite I would say, prevalent in the industry. I have seen people uh, like getting very excited when strategy works on only a single instrument or a handful of instruments, or even if it works like only for a very brief period of time and it does not generalize well over over long-term backtesting. So that is there, right? The next area that we are to discuss is the traders usually adding unnecessary complexities to their trading systems, right? So a trader is in the so a trader has been given task to come up with a new trading system. So he or she basically tries to simulate different phenomena in the market, right? And to simulate those phenomena, they sometimes use technical indicators, other times use statistical indicators, and they try to quantify those variables. Now, whenever they try to simulate those things, they generally believe that the more indicators they add, the more performance strategy will give, or the better with, or I would say, in other words, the more indicators they add, the better will be the strategy. But that's not entirely true. Uh, Oftentimes, it is seen that after having certain indicators, it does not matter whether you add any additional indicator or not, right? So, for example, if I'm trying to build a trend following strategy, uh, I can capture trend using one or two indicators, right? But if I try adding, let's say, like additional indicators that also tries to capture the I'd say the trend, okay, it will not add any value to my strategy. Okay, why? Because all I am concerned is with capturing the trends in the market, right? I can capture those trends with very well one indicator, or at max two indicators, right? But if I add five indicators, that simply shows me the same information, right? I am unnecessarily making my strategy complex. Okay, and with complex strategies, it becomes really difficult to uh, understand the actual working of the strategy, like if a strategy makes certain decision, why that strategy has made that decision, and when it should have traded, why it has not traded, right? So it is seen that usually two to three indicators works quite well most of the time. Having additional indicators does not add any information to your strategy. Okay, so I have this example over here wherein this particular strategy uses one, two, and other four, in total six indicators, right? Uh, just to capture the trend. I can very well go ahead and capture the same information content just by using three indicators. Okay, so over here I am using six indicators like linear regression, a linear regression curve, exponential moving average, a trend, super trend, right? ATR, momentum indicator, and all those things. Even in this particular chart as well, we can see that we can capture the same amount of information just using three indicators: EMA, supertrend, and ATR. Right. So the point is, whenever you guys go ahead and try to create strategies, just don't complicate them. Just don't make them complex. The simpler it is, the better it is. Okay. The next era that we are going to discuss is about the devils of the strategy, right? The slippage. As it goes with any other era, algo traders often think that they are virtually uh, they are they basically have these they are not going to get any slippage in the market, which is not true. There is no free lunch in the market. uh, Anytime any kind of strategy that you are going to use to trade in the market, you are going to incur slippages, yet alone transaction cost. Okay, so this is my so if anything that needs that can be taken away from this webinar is this part: do not ever conclude your strategy performance or take it to the next stage without incorporating slippages and transaction cost. They are the silent killers of your strategy, right? They are the ones which degrades your performance. Okay, so to give you a real example, here is a strategy that I have simulated, right? We can see that without considering slippage or any transaction cost, it generates these numbers, right? The drawdown is just like 4%, returns are 29%, and there's an alpha of 1.31%, which is quite good, right? Now, if I just include 5 cents worth of slippage, if I just include 5 cents worth of slippage, the performance degrades to these numbers. Okay, what is important to note from this slide is just 5 cents worth slippage reduces your Sharpe ratio by whole unit, right? Earlier it was 4.17. After considering slippage, uh, it has decreased to 3.45. More importantly, what is important is to it basically uh, it basically ate your alpha. See, earlier your alpha was 1.31, now it's just 0.99, right? So slippages and transaction costs are silent killer of your trading strategies. Uh, Quite often, traders usually believe that okay, whenever they trade, uh, if strategy is making money, uh, they don't care about slippages, they don't care about transaction cost, and they would assume that like they are not going to incur those really high slippage or transaction cost. But that's not the case. We often underestimate the number of trades strategy makes, the amount of slippage and the transaction cost that needs to be paid, right? Uh, if in this example I were to add transaction cost, I am pretty much sure that the performance of the strategy would reduce more. But that should be okay. Okay, so whenever we are creating strategies, uh, even after adding or considering the slippages and transaction cost, if your strategy performance gets reduced, that should be okay. It gives you a realistic idea about how your strategy works, and it sets the right expectations. Okay, so it is always better to jump into markets with your strategy with the right expectations rather than incurring huge losses with incorrect expectations. So if your strategy is generating less profits, but if it is consistently true to your simulations, you should be okay with it, right? So this is one of the this is the core of the this particular webinar. The next one is the next error that we are going to discuss is one of those errors that novice and the experienced traders of try like often fall for. Okay, which is they trade one instrument, they trade another instrument, right? Now this is one of the common ways to devise or to come up with a trading strategy. Traders believe that if two instruments correlate with each other most of the time, they are good to trade them. Actually, in I would say for most of the times it is not the case. Okay, even if one instrument behaves exactly similar to another, the chances are highly likely that those both instruments are not going to work in a similar fashion. Okay, uh, as I mentioned, sometime it works. Okay, more often it doesn't. So, what are some common examples of this particular error? Yeah, traders track index. They quantify the index data. They analyze the index data, and then they try to trade on their futures contract. So they say that okay, index and the index futures are going to behave exactly the same way. That's actually not correct. They behave in a very similar way. If we calculate the correlation would obviously come around like more than 90%. But the way index moves and the way the index futures moves are very different. Okay, usually index moves by uh, their how depending on how their constituents are changing. On the other hand, the futures contract would change based on their supply and demand. Yes, it is correct that if the index rises, the futures would also rise. But and if it doesn't rise, arbitrageurs will come in and they will basically take all that opportunity and it will eventually rise, right? But the fundamentals are different. We need to understand the intricacies of uh, each individual instrument, right? Uh, when people analyze index, there are no, I would say, the index is basically a single time series, whereas the continuous futures contracts are basically created from multiple expiries. So they are adjusted as such. Another example is very common in the commodity space, wherein people analyze the main futures contract and they trade on the mini futures contract, right? So they trade so they trade ES and they trade ES mini. Okay, they trade gold, they trade gold mini. Now again, as it goes with any instrument, the way these instruments are moving, okay, they are correlated, but they cannot be assumed to be the same contracts. Okay, it is often said in the quantitative finance or among the statisticians that correlation is not causation. Okay, so what causes the main futures to drive would not cause the mini futures to drive. Okay, though they are correlated, they do not cause each other to move. So that was one of the things that you guys need to very be mindful of. Now, the last two areas that we are going to discuss is more on the, I would say, the platform side, right? Which traders often use to trade their trading systems. So, say once the trader have built up, created a trading system, and now they have deployed it, right? So, when they deploy it, they often connect it to the brokers using some sort of APIs, or they use or whatever venue they are trading with, right? They usually go ahead and they would connect with them. Oftentimes, it happens that there can be any sort of issues that might creep in with regards to the technology. Okay, there are times when API goes down. There are times when connection to the data feed goes down and you get the stale data. Okay, there are times when the market suddenly there are times when the volatility in the market increases suddenly, and the users or the systems get jammed, and you get delayed response. Now, in certain scenarios, you might want to capitalize on those sudden market movements, or you want to close or offset some positions. Okay. Now, if those things happen, and if your trading platform also uh, becomes prey of those technology issues, right? And if you guys are not having a plan B, right, uh, that's an error on your part. So it is well known that like there are many platforms out there, there are many APIs out there, right? Who cannot handle like sudden surge in the volume, and by the time those things are resolved, you guys might have missed out on the trading opportunities. So it is always advisable to keep having access to multiple trading venues to build robust trading platforms and to keep stringent risk management checks in your system in your trading itself. Okay, so this is like if you guys are not having another like if you guys are not having access to other trading venues, or if you guys cannot offset your positions in the inadvertent movements, right? It is highly likely that you guys are to be blamed and not the technology. Next thing that and the last area that we are going to discuss is basically algorithmic trading systems, or algo trading systems, are not to be considered as a fire and forget systems. Algo traders often assume that once they start all their systems, once they start all their monitoring jobs, once they start their algorithms, right, they are free to do anything. They can go ahead they can go for a lunch break, they can go for loo break, and they can basically vendor off, and the system will work on its own. That's actually not the case. We are very far from these fire and forget things, right? Algo trading systems usually help us in building, in establishing uh, robust trading plans, but they are not fire and forget systems. Okay, just consider like what happens when, like in the morning, you started your trading systems, you started your algorithms, and at that time the markets were very calm. The markets had like everything was going smooth, right? But all of a sudden, some geopolitical news came in, and market started moving like quite drastically, right? Now, in those scenarios, you need to change the parameter values. You need to update the portfolio that you are trading, and you need to maintain like a whole bunch of operations, right? You need to give inputs to your trading system that okay, do not do not take more than n number of shares, reduce the positions, do not take say short trades, and you need to update all those parameters, right? So if you are not monitoring enough, it's highly likely that the the things can go haywire. Correct. So these were some of the errors that we are to discuss this time. Right. Now we will open the forum for the Q&A, and then we'll discuss.
That was an insightful presentation, Jay. So if we can switch back to the Q&A slide. Uh,
Yeah.
so now we'll answer some of the questions from the audience. So I will request everyone to put their questions in the Q&A section. And meanwhile, you are doing that. Before we start off with the Q&A, I would also like to invite my colleague Akhilesh to take us through the executive program in algorithmic trading by Quant.
Thanks, Satish. Hi guys, good evening. So my name is Akhilesh and I look after the Indian markets here at Complexities for the EPAT program. So a lot of you guys have been associated with Complexities for the last some time now, and some of you who have not been associated with us. I would just like to give you a quick gist of what Complexities is all about. Complexities is an ecosystem right from learning to executing your trades, where we like to basically get everything done under one roof. Right from learning of your strategy paradigms, learning of Python, any of those things. So amongst one of those, and amongst one of them, EPAT is one of the flagship programs of Quant State. It's a 6 months weekend only program where we have had people from 90 plus countries who have done the EPAT course. The course is basically recognized by Institute of Banking and Finance Singapore, CPD UK, and many other bodies. So before I get into that, I would just like to take you guys through a quick uh, map of the EPAT program. Okay, the EPAT program is divided into there would be preparatory session, primers, the live lectures, the optional sessions, there are resources, and there are projects. So now the EPAT program, first of all, before I move ahead, are you guys able to see my screen? If you guys can just confirm once, that would be great.
Yes, Akhilesh, you can.
Thank you. We start with the foundations of algo trading, as everyone comes from a different background. So we start with the foundations. Then we move towards your trading strategies, then portfolio and risk management, which is a quite important thing in algo trading, how to backtest your strategies, then how to create a trade sheet, setting up of your desk, create scripts for to trade algorithmically, where we cover various trading strategy paradigms and platforms. And then obviously we move towards how to post strategy evaluation, post execution evaluation, and your if people are looking for a job, we also have a dedicated placement cell as well. I'll just take you through a quick gist of what everything is. So when it comes to laying foundations, we cover trading psychology, macroeconomics, Excel, statistics, Python, market microstructure, various things. Once you're able to, this takes the first 1 month or so of the curriculum. Then we introduce you to trading strategies paradigms. Here we cover all the asset classes, where few of the lectures are for options and futures, few for ETFs. But whatever we do cover is covered with in such a manner that we can use it across multiple asset classes. We do cover strategy paradigms like time series, pair trading, machine learning based models. Then we also cover statistical arbitrage. We cover neural networks, sentimental analysis, reinforcement learning is also covered. Most important part would be your portfolio construction and risk management, where we do emphasize on this, and there's a dedicated module on the same. Then we basically help you with backtesting your strategies. Your how to backtest your strategies and how to optimize them is taken care of. We cover that with the help of Blue Shift and Interactive Brokers. Then from there, people who want to set up their own desk, there is a module on that. We cover Interactive Brokers, Zerodha, Upstocks, how to cloud compute is also covered. Then how to execute the strategies in the live markets and go live. Then once they've gone live, what is the we evaluate the strategy, how everything has happened. And then people who want to get a job also in the domain, we do have a dedicated placement cell where we have tied up with around 390 plus placement partners. So that is about the overall curriculum of the EPAT program. Kshitij, if you can just share your screen again for the Q&A part. I would just like to take people through the discount part of the EPAT program that we have currently introduced.
Sure. Okay. Jay, can you resume sharing the screen?
Yeah. So guys, currently we are offering a 25% discount on the super early bird fees for the EPAT program. We are offering 25% discount on the standard fees, which would come lesser than the super early bird fees as well. You can opt in for this offer in the next 48 hours, but you would be able to apply this discount for the October batch, and the last date to enroll with this discount and the super early bird fees is going to be the last day of this month. Apart from this, people who are from the Indian markets and developing markets, there are other additional discounts and subsidies as well that are applicable. To know more, you guys can book a call and your post counselors will be more than happy to help you out. Thank you very much, guys. Over to you, Jay and Kshitij.
Thank you, Akhilesh. I have also put the link in the chat, and in case any of you need any guidance, you can simply go to that link and book a slot with any EPAT course counselors, and they'll be happy to answer all your doubts and questions. Thank you, Akhilesh. So I can see that there are already certain questions popping up in the Q&A section. So Jay, you're free to pick
Yep, sure.
those questions and answer them.
Sure, thanks. Thanks. So let's go through some of the questions. One of the questions that we have received here is like, what is a good Sharpe ratio? So that depends on what kind of strategies that you are developing and trying to come up with. Anything that is greater than 1.5 for retail traders is good. If you guys can come up with Sharpe ratios in the range of 2.53, that would be excellent. Within the professional settings, Sharpe ratios greater than 2 or 2.5 is generally considered good. Is backtesting on only 1 month of data enough? Unfortunately, no. When you backtest your strategy on just 1 month of data, you are highly likely to get skewed results. Okay, that 1 month of data won't be comprising all the market regimes. It won't be comprising all the market scenarios, and it is highly likely that if the market sentiments change or if the market dynamics change, your strategy might not perform as it was performing in your simulations period. So it is always advisable to backtest your strategy on as long data as you can have, or just try to simulate at least around 1000 trades, right? That will give you a good enough idea about the strategy itself. What is the difference between running algorithmic trading and day trading systems? Okay, so when we say algorithmic trading strategies, we mean that the strategies are the trading signals are being generated by the system, and oftentimes they are being traded by the systems themselves. Okay, when we say day trading strategies, it simply means that strategies trade only during the market hours. It can be automated, or it can be a manual one as well. Okay, so I just analyze some data and I just put those trades manually with my broker or with my exchange. What would be your advice regarding algorithmic administration in terms of cycle and monitoring process? So when we say monitoring, I would say when we say monitoring, I would say it should be a continuous process. In terms of revalidating your ideas, you should consider it like periodically. Now that depends on how the strategy is being performed. So if you had used work forward optimization, then you would know in advance when your strategy needs to revamp, or when your strategy needs to calculate new parameters. Okay. Now, what is the best optimal leverage you need to use? Ideally, a risk averse person would not use any kind of leverage, right? But uh, computing optimal leverage is a field in itself. There are quite popular trading sizes that people use in different settings. There is a really good book by Ralph Ralph Vincent on taking position size. I would recommend going through that book to consider or to decide on what optimal leverage one can use. Okay. Next, we have questions about I day trade stocks and options and futures. Do you offer algos and bots? No. So again, we don't offer algos or bots, but rather we teach them how you can create on your own. Can you? So someone has a question. Yeah, sure. I can. Just give me a moment. I can put. So the book name is here. All right. So I believe I have answered all the questions. Yep. Thank you so very much, guys, for attending this webinar. I hope you guys would have found quite insights about the how algo traders work and what kinds of error they make. I wish you all the very best and take care.
Thank you, Jay. Thank you so much for this wonderful session. And a big thank you to everyone who participated in today's webinar. Special thanks to speaker of the day, Jay, for sharing his knowledge and experience. In case there were any doubts or queries that remained unanswered, feel free to ask them in the webinar survey that you will receive right after this webinar. And we'll make sure that all of your questions are answered by our team. Uh, and yeah, so I will see you in our upcoming session soon. Have a great day ahead. Bye for now. Thank you, everyone.